Hello my fellow investors and welcome back to another earnings report and stock analysis video. I am so sorry guys that you're getting this late. It's just I was just not able to record anything yesterday. I fell asleep and I woke up like middle of the night. So I'm so terribly sorry that you guys did not get any 4 p.m. video today on the 16th. So I am going to make it up for you guys, and I'm going to put 2 videos out for today, and when you're going to see this on the 17th. So we're going to get started guys with, of course, analyzing one of the companies that, well, this company has been on my radar for a little bit, and every single time I looked at it in the past, it was always such like, oh my god, like the price that it was at to the price that it was telling me, that like what my calculator was telling me, it was always mind-boggling. And now it's gotten to the point where I've been proven correct, honestly. Like those videos in the past, if you go and see them, they've aged pretty well. And I'm talking about, guys, the company Crocs. They just had earnings today, pre-market, and they absolutely crushed it. I'm talking about like pre-market up 14%. I'm not even joking. It was absolutely insane. So we're going to take a look at those earnings, see why they went up. Let's also take a look at the fundamentals and then make a prediction as to what the valuation of the company should actually be at. So with that said, let's get started with this analysis. So let's start off with Seeking Alpha's earnings report summary. We got EPS normalized actual came in at $2.65, beat by a whopping 42 cents. EPS GAAP actual $2.20, beat by 35 cents. Revenue actual $945.16 million, which is a beat by $6 million. In every single aspect, guys, they absolutely crushed it. And, well, their share price definitely showed. I'm going to show you guys exactly what I mean in just a little bit. But for now, let's come into the actual earnings report and see what we can actually learn from this. Because even though they did beat on analyst estimates, that doesn't necessarily mean that they are still growing year over year. So let's actually read what they actually got over here. First things first. Crocs Inc. reports record annual revenues of $3.6 billion, growing 54% over 2021. Full year operating income of $851 million and adjusted operating income of $986 million. Full year diluted EPS of $8.71, adjusted EPS of $10.92. That is again full year diluted. Now we got over here, guys. Well, actually, we're going to start off with the CEO's comment, apparently. Quote, consumer demand for the Crocs and Hey Dude brands has been exceptional, fueling record 2022 revenues for both brands at a combined $3.6 billion and top-tier adjusted operating margin of 28%, said Andrew Rees, Chief Executive Officer. We anticipate another record year in 2023, with growth expected to be led by sandals and international for the Crocs brand and increased U.S. market penetration for Hey Dude. So right there, guys, if that's what they're expecting, we really need to uptick those future projections when it comes into the revenues, which, by the way, analysts already have. A little bit too hype for me, but nonetheless, they already have. They go on to say, Crocs Inc. has industry-leading operating margins and generates robust cash flows as a result of simplicity of our product lines and high penetration of molded products. Post the acquisition of Hey Dude, we reduced outstanding debt by $550 million and gross leverage to 2.25 times, said Ann Melman, Executive Vice President and Chief Financial Officer. We remain confident in the gross leverage being below 2 times by the middle of this year, giving us greater flexibility with capital allocation. Really, guys. So right there, guys, they're just projecting like all positive things into the future. So definitely something to take note of. We got over here selling general administrative expenses SG&A of $276 million, increased from $212 million in the same period last year, and as a percent of revenues improved by 690 basis points to 29.2%, primarily due to leverage of the shared service across both brands. Adjusted SG&A improved 780 basis points compared to the prior 27.3% of revenues. Adjusted SG&A excludes $18.2 million of costs primarily related to the shutdown of Russia direct operations and the Hey Dude acquisitions and integration. Income from operations increased 37.5% to $220.1 million, and operating margin was 23.3% compared to 27.3% for the same period last year due to the lower gross margin in the Hey Dude integration expenses. Diluted earnings per share were $2.20 as compared to the $2.57 for the same period last year due to lower tax benefits. They even go over, guys, their balance sheet and cash flows. Cash and cash equivalents were $191.6 million as of December 31st, 2022, down from $213 $14.2 million as of December 31st, 2021. Inventories increased to $471.6 million as of December 31st, 2022, compared to $213.5 million as of December 31st, 2021. This increase was driven primarily by the addition of $168.7 million of Hey Dude inventory as of December 31st. Cash provided by operating activities rose by 6.3% to $603.1 million during 2022 compared to $567 million during 2021. Capital expenditures were $104.2 million during 2022 compared to wow, that's a massive jump. Oh my god. So they went from capital expenditures of what, 55.9 million, so $56 million in 2021 to 104. So they almost, well, yeah, like they pretty much nearly doubled it, which is absolutely crazy. A little bit less than double, but nonetheless, it's absolutely crazy. Borrowing as of December 31st, 2022 were $2.3 billion compared to $771 million. Wow, they even borrowed more. An increase driven by borrowings used to finance a portion of Hey Dude's acquisitions. Oh, okay, so they just borrowed more money in order to pay for the acquisition. Okay, so that's perfectly understandable as to why they did that. Now I actually want to take a look at their financial outlook for at least the first quarter of 2023. And they go on to say, with respect to the first quarter of 2023, we expect revenues to grow approximately 27 to 30% compared to the first quarter of 2022, revenues of $660.1 million. Adjusted operating margin approximately 24% to 25%, adjusted diluted earnings per share of $2.06 to $2.19. Now, in regards to the year of 2023, this is what I really want to see. We got over here revenue growth 10 to 13% compared to 2022. Keep those numbers in mind because I will use those numbers for the discounted free cash flow when we get to that point, resulting in a full year revenues approximately $3.9 billion to $4 billion at current currency rates. All right, so remember guys, those numbers, they go into more detail over here, but again, you guys can find this link in the description below if you guys would like to read it for yourselves. I would like to come now into these numbers in order to compare them to what they were in 2021. Now they are in thousands, so just keep that in mind. For the 3 month ended December 31st, 2021, it was $586.6 million, and in 2022 it was $945.2 million. For the year, it was $3.6 billion as we saw. So now for the net income, we got $154.8 million, and then 2022 it was $137.7 million. For the year, it was $540.2 million. And of course, looking at the net income per common share, they did go down from $2.63 to $2.23 from 2021 to 2022 in the basic, and $2.57 from 2021 to $2.20 for 2022. So now let's actually take a look at these fundamentals. Of course, we're going to come into the calculator. We got the ticker symbol for CROX, Crocs, market cap of $8.1 billion and a PE of 14.47 with a current share price of $131.20. Guys, this share price today was nuts. Absolutely crazy. And here's the reason why. As of the 1 year ago, guys, they're up a whopping 38.4. 1 year ago, most companies have fallen on the 1 year, and year to date they're up 22.83%. Absolutely crazy. This 52-week range is just insane, guys. Look at this, $46.08 to $143.50. Guys, that is insane. We're near all-time highs at this point. That's crazy. Now take a look at the share price. Okay, look at this, 4.4% up on the intraday, and post-market it is down a little bit more than 0.5% to $130.50. The problem with this is that this isn't telling you what it went up during the day. And in fact, if we take a look at this, guys, look at this thing. Look at this thing. Within what, 9:30, within market open, all the way up to around not even 15 minutes. In 15 minutes, this thing shot up nearly, well, actually at one point it went up to like 14%, but it got as high, guys, as like 13.77% in 15 minutes. That is absolute insanity. Now throughout the day it did come down a little bit, but it was still significantly high. I mean, 4.4% in the day, that's absolutely crazy. 14% nearly at peak. Absolute insanity. And on top of that, guys, this company does not pay out a dividend, so all of that cash flow is going straight into themselves. As you can see, their cash flow is at least increasing, but their graphs are a little bit strange. Let's get into that right now. Starting, of course, with the net income, we got 5 years ago of $50.4 million to 1 year ago of $557.3 million, increase of a little bit more than 1,000%. absolute insanity. You can see that 2 years ago they definitely spiked, but they came down as of 1 year ago. By the way, 1 year ago, guys, is 2022. 2 years ago is 2021. 3 years ago is 2020. So take a look at that. Even during 2020, they were still up. Now, again, massive jump from 3 to 2 years ago. And I would even say even from 4 to 3 years ago, it's still a pretty big jump. That's why I'm giving this a 65%. Looking at the free cash flow, unfortunately, it's similar to the net income, but not exactly the same. We actually see a drop in their free cash flow from 5 to 4 years ago from $102.2 million to $53.4 million. However, on the 5 year, it is $102.2 million to almost $350 million. That is an increase of 241% with an average of $248.2 million. Guys, again, I'm actually going to give this a little bit of a lower grade than that than the net income, mainly because we do see a dip here from 5 to 4 years ago. So I'm actually going to give this a 55%. Looking now at the revenue, this was actually looking very good, consistently increasing with, unfortunately, a pretty big jump from 3 to 2 years ago. But nonetheless, 5 years ago of $1.1 billion to 1 year ago of $3.2 billion, increase of almost 193.75%. And the fact that this is looking fairly steadily increasing. Again, 3 years ago to 2 years ago, slight jump. I'm not necessarily liking going from 1.3 billion, well, let's say 1.4 billion to 2.3 billion. I'm giving this, guys, a 90%. At the total assets minus the total liabilities, this one is very strange because, well, they have been positive. However, we do see an anomaly here 2 years ago of $14.1 million. That is a drop, guys, from the prior 3 years ago of $290.6 million. That's a pretty big hefty drop. And then the following year, boom, they just rose up. Now, here's the thing with this, right? We just read that they prioritize lowering their debts in 2022, or at least in 2021. Sorry, that was 1 year. Well, actually, 2021 was 1 year ago. But remember what we read in the earnings report, that they are focusing on lowering down their debt. So just keep that in mind. However, take a look at these fundamentals, especially on the net debt and liability. Sorry, not net debt, total assets and total liabilities. When it comes into the liabilities, we can see a massive jump from, well, the 2 year ago value of 1.5 billion to then almost $4 billion. So a little bit more, actually way more than double in their assets minus in their liabilities. However, we do see something similar once again when it comes into the assets. They went from 1.5 billion to 4.5 billion. So they increased their assets, but they also increased their liabilities. This was probably due to the Hey Dudes brand kind of thing, so that may attribute to that. But nonetheless, if that's the case, so that's at least understandable. Average total assets is around 2.5 billion. Average liabilities is 2.2 billion. So in this difference, we get $340 million. I have this grade as a 45. But honestly, now that I've read the earnings report a little bit, kind of have a gist of what's happening here, I'm actually going to increase this to around like a 55%. Looking now at the cash flow minus the liabilities, this one is just bad. It's just really bad. I get that we just said, you know, okay, they're at least increasing their assets with their liabilities. However, guys, this was a reoccurring thing even back 5 years ago. 5 to 4 to 3 to 2 to 1 year ago, they was consistently increasing. Only as of 1 year ago is when they dropped massively to negative $3.56 billion. And even the years where they had pretty good free cash flow, as you can see right here, 2 years ago, their highest free cash flow to date as of the past 5 years, they were at negative $1 billion. So that's definitely a problem. Average cash flow minus the average total liabilities, we get negative $1.2 billion. I'm sorry, but I understand why they're taking on debts, but I have to give this a 0. I really do. Because not even 1 year did they bring this up a little bit. So I have to give this a 0%. Looking now at the shares outstanding, this one caught me by surprise because, well, it was looking good up until 1 year ago. 5 years ago, guys, they had 73.3 million shares to today of 61.7 million shares. That's a massive decrease in the 5 year of 15.83%. However, from the previous year to the current year, that is a small increase. Actually, it's not small at all. That is an increase of 5.83%. You can see that right there. 2 years ago, 58.3 million shares to today of 61.7 million shares. Okay, so I'm actually going to give this an 80%. Here's the reason why. On the 5 year, they are at least decreasing it. And for all we know, probably the reason why they issued more shares is to pay off some of that Hey Dude acquisition. Again, I know they said they were borrowing, so they probably issued a little bit of shares as well. If that's the case, I still think that this will go down in the future. Honestly, this jump over here, if this was more consistent, I'd be afraid, but the fact that they have just been buying back, guys, it's looking very good. So I give it an 80%. And lastly, looking at the cash and equivalents, they currently hold $143 million with an average of $149.3 million. And of course, we got to take a look at the overall grades. We gave them the income of 65%, free cash flow 55%, revenue 90%, assets minus liabilities 55%, cash flow minus liabilities 0%, shares outstanding of 80%, overall grade of 62. Now you're looking at this and you're like, oh God, that's not passing though. But you want to know something? I actually do like this company. I really, really do. Even though the grade is only a 62 for me, this is where investing, guys, becomes an art. Just because the numbers are telling you one thing doesn't mean that you shouldn't buy it, right? At the end of the day, well, first of all, every investment is the present value of all future cash flow. But second of all, it really just depends on you, right? The numbers are only there to guide you. The numbers are just there to be like, hey, these are a couple of red flags. Now, time to do a little bit more due diligence if everything else seems intact, right? And by the looks of it, at least for me, I actually do like this company a lot. And I've actually sold a couple of puts on it. One of them is actually expiring tomorrow. And I actually made pretty good premiums on it as well. So at the end of the month, I will show you guys my premium income as well as my dividend income too. So be on the lookout for that one at the end of the month. But with a 62%, I know you guys say, well, that's not 70. Right, that's not 70. But just because it's not 70 doesn't mean that I don't like it. And we're going to go into the reason why I actually do like this company. And this reason is why I don't mind the 62%. And that is, guys, the target share prices. Is $130.40 a good buy right now? I don't know. Let's find out. Now, for the revenue growth, as you can see, I have here 5, 6, and 7%. Now, according to Seeking Alpha, analysts are expecting a forward of 42.07%. Okay, that's a little bit too much for me. However, I actually inputted these numbers before I read the 2023 guidance. And again, if you guys remember what that was, is revenue growth of 10 to 13% compared to 2022. So let's actually go with that, right? Let's put in here for the lowest assumption, let's put 10%. For the median, let's go around half. So I said what, 10 to 13. So let's go at what, like 11.5. I think that is the middle. I think that's the median between both of them. And for the last one, let's go with 13. There we go. And now for the projected share buyback, I think that they'll continue to buy back shares. However, I think they're going to slow that down in the next 4 or 5 years. Instead of 15, I think at max they'll do 8, and at worst they'll do like, actually, you know what? I may take that back a little bit. I'm going to go with probably 5, 6, and 7% for the predicted share buyback. And guys, take a look at these numbers. With a required rate of return of 10%, not adjusting for debt, $273.92, all the way up to $308.58. Guys, I put the numbers, especially the revenue numbers, that they had right here in their earnings report, with the revenue expected to grow 10 to 13% compared to 2022 for 2023. So I'm putting the numbers that they're telling me to do. So with that, take a look at that. $273.92 to $308.58. Adjusting for debt, this does come down, but guys, it's still $229.43 to $263.17. With a margin of safety of 5, 10, 50%, guys, $195.01 to $250.01. That's insane. And you're probably looking at these numbers and you're like, dear God, there's no way that that's correct. The stock has never gotten that high. Okay, let me tell you all something. And we're gonna take a look back at memory lane. We're gonna just go back a couple months. Actually, it wasn't even that long ago. And let's take a look back at the earnings video I made for Crocs. I believe this was last quarter. So we're over here, and if I'm not mistaken, this was made 3 months ago, as you can see right there. 3 months ago video. So this was definitely done last quarter. Guys, take a look at these numbers. Okay. I pretty much just went the same thing. I went 10, 12, and 14% for the revenue, and 4, 5, and 6% for the projected share buyback. Look at what the share price was back then, guys. $76.60. What is the share price right now? What is that share price right now? 130, and it was higher today, by the way. It was higher. $130.40. Yeah. to all those people who probably were pretty negative about this company when I first visited, I don't think anybody was though, but if there were any skeptics, guys, in 3 months, in the last quarter, they were $76.60. This quarter, $130. If my numbers are correct, this price, this stock should be worth at max $308.58. Please take that with a grain of salt. Because again, this is not financial advice. Every investment is the present value of all future cash flow. But so far, all right, so far as I'm looking at these numbers, I think I'm being proven correct here. So if you bought, let's actually do some math over here, okay? If let's say that you bought this company at $76, which was back in the third quarter. Let's say you saw my video and you saw, oh my God, you know, that's absolutely crazy. You thinking it's going to go to like $414 or $415 over here or whatever. And you guys actually bought it. Okay, I'm not, again, not financial advice, but if you guys actually bought it, let's actually see what would happen if it were to go to just, let's just say like $300. Dear Lord. So if we do over here, 300, let's just say that you invested, I don't know, $10,000 into this company at 76, right? So we're going to do $10,000, divide that by 76. That ends up being 131.57 shares. Okay. So keep the number in mind, 131, let's just say 131.6. So 131.6. So now we're going to do 76. Sorry, not 76. We're going to do, let's just say 300, right? 300, since that's the number that we're pretty much just getting right here. So $300. $300 minus 76, right? Times, let's actually big screen this for a little bit. Times, so that number right there, so 300 minus 76, that's $224 difference. So now if we multiply that value by that 131.6 shares, so 131.6, guys, your profit would be $29,478 if this thing actually does go up to $300, which so far my calculator has proven me correctly. Dear Lord, guys, absolute insanity. So again, please take these with a grain of salt. I am not saying that this is going to happen. Okay, for all we know, their shoes could just go the way of the dinosaur. Everything could come down. They lose a ton of revenue, all that stuff. However, if things were to continue the way that they're going right now, this does seem to be plausible. I'm not even joking about that. It really, really does. And that's the reason why, even with this grade of 62, I actually like this company, believe it or not. And I'm actually selling puts on it. I'm selling weekly puts on it just to make a premium. And I also have a long put for a price of $75 for June of this year. So there was, for some reason, there was volume at that point, and I was just like, you know what, I would not mind owning this company at 75. We'll see what happens. If it falls there, then I buy it. If not, then I keep the premium. So it is what it is. But again, please take these with a grain of salt, guys. I'm not saying that this will go to there. I'm just saying, based off of these numbers, this is looking like it should be around $229, $230 to $263 adjusting for debt, and up to almost more than $300 not adjusting for debt. So please do your own due diligence. It's not financial advice. Every investment is the present value of all future cash flow. Have this calculator and input your own numbers, because for all you know, you guys may get something completely different, and that's perfectly fine. I'm just saying these are my numbers. Definitely do your own due diligence, right? You may not like this company, but please have these calculators. They're all available for free for that reason. And by the way, I also just changed, guys, the discounted free cash flow, at least where you input the fundamentals. I changed them. Hopefully this should be correct. I think I fiddle around with the formulas, and now you shouldn't have to constantly be changing the formulas as before. So if you guys have the old version, if you guys have not had the new one since as of recording this video, please have it. Again, it's available for free, guys. Link is in the description below. This one, book value one, reevaluation, and a dividend tracking sheet. Even though this company doesn't pay out the dividend, I still recommend for you guys to have it, because it still tracks your capital gains. It tracks pretty much everything. So thank you all so much for watching, everybody. I really do appreciate it. Again, the best way that you guys can help is just like, subscribe, comment. It really does help. Thank you so much for the 2,000 plus subscribers. Y'all are crazy, and just cannot do it without you. So thank you everybody for being so supportive, for me adding my friend, which he's mainly doing technical analysis. Thank God that you guys actually do like that. So I really do appreciate it. No, again, guys, the best way that everybody can support us is just like, subscribe, comment. That's about it. So all in all, when it comes to Crocs, as I said, I love this company, and the fundamentals could be a little bit better. Honestly, they could. But that price, man. That price. That price is just insane. It's just absolutely crazy. So again, that's just me. If you guys think different, leave it in the comment section below. Please do your own due diligence. It's not financial advice. Earnings report will be linked in the description below. So will be the link to the discounted free cash flow. You guys can make your own assumptions. You guys can read the earnings report and make your own decision for yourselves. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow us on the YouTube sites. Link in the description below. So with that said, peace out. And I will see you all in the next earnings report video as well as stock analysis video.